Good evening, everyone, and welcome to our Industry Talk series number 9, represented by JSOM Finance Lab at UT Dallas. My name is Soni, and this is my co host Sumaiya Ansari. And today we have with us two esteemed guest speakers from the First United Bank, Paul Hoerig and Stephen Pipes. Welcome, Paul, and welcome, Stephen. So
Thank
today we
you.
will be, sorry.
Thank you. We're glad to be here.
So today we will be discussing about their career journey, best practices as a professional in credit management, current economic and industry trends, and get some career advice from them as well. And in the end, we'll leave some room for open Q&A sessions from the audience. So to begin with Paul Hoerig, Paul is a seasoned financial executive with over 2 decades of experience in banking, specializing in credit and risk management. And currently, he serves as the Chief Credit Officer at First United Bank. Stephen is highly experienced financial executive with over 30 years in the banking industry. He currently serves as a Deputy Chief Credit Officer at First United Bank and has an extensive experience in credit management, lending, and commercial real estate. I must say, I admire your passion, guys. To Sumaiya now.
Thank you so much, Raj, and welcome, Paul and Stephen. Thank you so much for joining us today. So, Paul, you've been in the banking industry for over 2 decades, which is very impressive. I'm curious to know what sparked your interest in this field and what would you say are the key skills that have paved your way to success over these years?
Uh, sure. So I started longer than I care to admit in a small bank in my hometown in Wisconsin, and so I was branch manager slash lender slash kind of did everything there. And so from there, I spent a few years lending and really spent long enough time there knowing that I needed to find something that was better suited for my analytical background. And so really the piece of credit that got me started and I still enjoy today is it's all about analysis and problem solving. And those are two things that I really enjoy. I've been fortunate over the last 20, 25-ish years to have a lot of different opportunities in that space and now have a chance to lead that function for our organization here.
Awesome. That sounds amazing. Thank you so much. And I believe that one of the key skills for a fulfilling career is really the ability to adapt to different roles. And Steven's profile exactly highlights that. From working in a commercial real estate side to credit, I would like to ask Steven, how has your journey evolved over the years through different roles and companies, from real estate to credit risk? And what advice would you have for someone who's entering into a new sector or a domain?
So, kind of like Paul, I've been in banking for a while. I actually started out working in summers while I was in college on the operations side of banking. And then when I graduated from SMU, I started my banking career in Dallas. And like many young people, I started as a credit analyst and then I managed a team of credit analysts. So I felt like I got a really good credit background, but my goal at the time was to get into lending. So I moved into lending early on. I did C&I lending, business lending, and commercial real estate. And over time, the bank that I was with was bought by a larger bank, and they had more specialty departments. So at the time, my passion was commercial real estate. So I spent a number of years being a commercial real estate lender and then leading a team of commercial real estate lenders. And then over time, I was a market president and regional president. And I started thinking about I'd done what I wanted to do on the production side, on the lending side. I still had what I considered a really good credit background. And so I decided to look back into the credit side of banking. And kind of like Paul, I enjoyed the analysis. I enjoyed looking at different types of credits. And so First United happened to contact me about a credit role 11 years ago. And so I joined First United as a senior credit officer. And then over the 11 years that I've been here, my role has changed somewhat and currently Deputy Chief Credit Officer in Texas. But as far as the skill set, I think on the credit side and the risk side, it's important to be very detail oriented. I think it's important to always have an open mind and to be aware of what's going on in various industries, to be aware of what's going on in the economy. But I think, primarily just being willing to look at lots of deals with an open mind and to utilize background skill sets and, those skills that we build along the way.
That is really impressive. So, like moving on from this, we would like to ask you about some of the practices at the First United Bank. So, as some of us are aware that after the financial crisis, it became a federal law to do stress testing such as CCAR and DFAST. But I'm sure that it is not compulsory for the community banks. So, what are the primary risk management practices that are used at the First United Bank?
So I'll start a conversation here and drift into maybe some controversial thoughts. So when all that came about, that's actually when I was at a larger organization, and so had a front row seat, not only being there as a credit professional, but also got brought into that process. And one of the things that I'd encourage you to all, or I would share with you all, is when the government and or regulatory agencies do that, they make it seem a whole lot more valuable than it actually is. And so, yes, there's a lot of rigor that goes into it. And yes, they talk about stress testing. And even today, we talk about how all the larger banks are passing these stress tests. That's okay, but it's just all numbers running through models, which there's some value there. But what really matters is how each organization makes their credit decisions. And so for our organization, the reason why we continue to perform well through another challenging cycle, and we performed well the last time, is we believe in placing decision making in our markets. We have 7 identified really business units, 6 regions, and then a specialized group. We empower them to get to know their clients and support them with good decision making. And then we have a conservative credit culture. And so I would say that's basic blocking and tackling. We have credit officers, and Stephen is a deputy chief credit officer. He is far and away our strongest empowered decision maker. He has peers across the bank. That's the way that banking is done. We'll be successful because of that. All of these other risk management techniques, they're interesting, but it's just all projections going through various regression analytics and modeling, it's okay for some folks, but it's really not what banking is about. And it's not an indication of true risk in a portfolio from my perspective.
So what I understand is like you give more importance to the service and making connections with the clients.
Yeah, I mean, things like stress testing. It's about taking various data inputs and putting it through some type of a model and some kind of a stress scenario. That's interesting to look at, but it doesn't take away from lending is foundationally about making the right decisions in your markets. And when you do that, your loans will hold up during stressful times. That said, even though we're not subject to that stress testing, we still run it on our own portfolio. So we still do it, even though we're not required, because it's a risk management technique. Just for me, in terms of running the portfolio, I put a whole lot more stock in the fact that I've got Stephen making credit decisions than what our stress tests tell me.
Oh, I understand. So, Paul, are there any key challenges in assessing and managing credit risk for small or medium enterprises?
Yes. Interestingly, probably one of the most challenging is, as a bank, we're like anybody else, we're out there competing for business. And we have a defined credit culture, and we have areas that we like to lend into more than others. Our biggest challenge is staying disciplined when we deal with more irrational competition. And so everybody has a right to make their own decisions, but it's challenging for us to grow as much as we want to when you see other organizations leaning in beyond what a normally expected risk appetite would be. So that can be one challenge, but we stay disciplined while we're doing that. And then the other is, making loan decisions. And certainly we can talk about looking at things like debt service coverage and loan to value, financial statement metrics. That's the easy part. The harder part is understanding what I describe as business model risk, which is how are all these different companies in various industries going to stand up over time? We're in the process of really evaluating that. When you look ahead the next 5 to 10 years, it's a little bit harder to do that. with a lot of the economic challenges going on right now. So that's probably a bigger challenge for us on a day-to-day basis.
Thank you, Paul. Thank you for sharing so much light. So my next question is for Stephen. So, Stephen, since you have been into commercial real estate and you have seen through different times how the commercial real estate field has been evolved. So lately we see that currently the commercial real estate is under extreme stress. So how does First United Bank manage its CRE loans under this kind of stress? And are there any steps being taken to mitigate the non-performing assets on the balance sheet?
Yeah, so I think the main thing is to look at stress testing. As we all know, certain segments such as office, they're not performing like they once did. There are loans that were booked at lower interest rates that have rate resets, and a borrower's interest rate may be going from 5% to 9%, which is a big change. So we're very proactive in looking at the portfolio and looking ahead to stress test and know, based upon interest rate resets, what will the debt service coverage be on this loan. We also, especially on our larger loans, we get, updated rent rolls at least quarterly. And so we're looking at the occupancy of the building. We're looking at the debt service coverage. So I think it really just boils down to being proactive in the commercial real estate portfolio, monitoring the markets. There could be differences from Oklahoma City to Austin to certain areas of Dallas. And so we utilize third-party market data research so that we can drill down to market rents, market vacancies, and that can help us with our stress testing as well.
So one quick tag on to that, and this is another, I always try to think about one or two takeaways that I'd encourage you all to take from today is even as you process information out there about what's going on with commercial real estate and stress in the market, I would really encourage you to dig in deeper than normal to look at the source of the information and where they're referring to that stress, because it's highly regionalized. And we've spent a lot of time doing it because as we communicate internally, we're talking a lot about perception versus reality. And to Stephen's good point, we have some stress in our portfolio, but our markets have held up pretty well. And back to them, this all predates me. It's a credit to Stephen and others who have been here a lot longer. Very disciplined credit culture where we were stressing interest rates when we made those decisions. Most of the stress you're reading about is in highly metro markets like Chicago and DC and New York, or coastal markets. And I want to be careful, and I'll knock on some wood, sitting here today, our commercial real estate portfolio is holding up very, very well.
Awesome. It's really good to hear about your controls on CNI lending and stress testing and how that works for First United Bank, irrespective of whether it's a legal requirement or not. And coming to the whole company culture, we explored the First United Bank's website and came across the bank's core value of spend life wisely. So, Stephen, could you please elaborate on the company culture and how do you balance between the value system, the underwriting process, and credit risk management?
That's a good question. As you said, our motto is spend life wisely. And what it means to me is that we all want to be multidimensional. We don't want to be working 24/7. We can't be playing 24/7. We have to have a work-life balance. And I think it's particularly when it comes to customers, it boils down to what I like to call as do the right thing. I don't think our credit decisioning is just a yes or a no. We look at deals with an open mind. Not every deal works, but we look at it and go, okay, is there a way to make this deal work? If it's a situation where we may need additional collateral, we may need an additional guarantor. If it's based upon projections, we have a great SBA group that we can bring in to get an SBA guarantee on some types of deals. So I think, as Paul mentioned earlier, we have, well experienced loan officers, and we want to look deeper and see, under what circumstances could we do this deal. Also, as I said, it's not just a yes or a no. If it's a situation where we can't do a deal, part of it is educating the customer. Why does this deal not work? Is there something that the company can do that would make it work, maybe 6 months down the road? Or if it's something that doesn't fit bank financing, is there alternative sources of financing that we can refer them to? So what I like to say is we don't ever want to give a hard no. We want to educate. We want to help them understand what our decisioning is, how we came to that decision, and how we still might be able to help them. And then, for the good news, when it's a yes, it's not only about making a loan, it's about how do we service that customer? Could they benefit from treasury management services? Do we have other, bells and whistles and services that they can benefit from? And then I think lastly, the other part of it relating to customers is educating them, not just about loans, but about finance, about banking. So we have various pillars, and part of that is educating the clients and prospects in our market. So we'll have educational seminars where we have clients that come in and learn about various topics. Some of them will be like a lunch and learn. Some of them will be after work. And then in some of our markets, we're also doing a leadership academy for customers where they come in once a week over a period of several weeks, and we have leadership classes about skills for running businesses. So again, it's not just about making a loan decision. It's about how do we treat that customer correctly? How do we educate them? And how do we become a partner in their business?
Yeah, that sounds amazing. Paul, do you have anything to add on this?
Well, just a quick dovetail on, and Stephen hit on it very, very well. The way that I think about our value system, and especially how we operate our business, is we're a community bank, and we partner with business owners and individuals with similar values. And that not only creates a good relationship from a banking standpoint, but, as both, potentially you'll have borrowers that go through difficult times. Because we're banking with folks that have deep values and believe in integrity, it's a lot easier to work through those situations because they're going to fundamentally do the right thing.
That makes a lot of sense. And especially for community banks, doing the right thing is what is the ground of the whole bank. And coming to sustainability and also ESG, does your bank incorporate ESG factors into its investment decision and the risk assessment? And if yes, then how?
Yeah, so I'll start this, and Stephen can certainly jump in as well. We were both talking to those themes earlier. So we don't approach it like a much larger public company would with a formal program around it, but really a couple of ways to think about it. Certainly our focus on community bank lending goes beyond what we talked about, which is making a good business decision and being privately held and having a majority owner who believes strongly in supporting our communities. We will lean in significantly and lend into our communities to do not only what's right for our value system, but also what's fundamentally right for our communities, whether it's lending to nonprofits or supporting our communities in ways that even similarly sized banks don't. And we're able to do that because of our ownership's commitment to it, because we're privately held and we're somewhat outside of that transparency. We can make some investments and decisions like that aren't necessarily under the same level of scrutiny. We just get at it a little bit differently because we're not publicly traded.
Sounds good. Yes, Stephen.
Oh, I was just going to say the only thing that I would add is, back to the question about ESG. When we look at lending to companies, there's such a wide array. So, of course, we want to be aware of what factors may affect those companies and their industry. So we always want to be aware of how those factors may affect companies that we're loaning money to. So, those ideas will always be part of the decision making, and it's part of the risk profile of certain industries are more risky in certain areas, be it environmental or other areas. So as a risk professional, the more we know about an industry, the better, so that we can underwrite them properly.
So thank you, Stephen and Paul, for sharing with us about the First United Banks and how it conducts its practices. Now we would like to touch upon some of the economic trends and current situations as well. So my question is, since banking business is closely tied with economic policy, and we have seen a lot of economic policy changes in the last year, government tightening its policy. So how do you incorporate such economic indicators like interest rate or inflation in the risk assessment business? And being a young professional, what things should we take care of as well?
So just to start off, I think part of it is having access to third-party data. We use Moody Analytics. We use RMA for various industry comparisons. We use IBIS World. So we have a lot of data from third-party sources that we can use to put into our stress test models to look at how does economic environments affect certain industries. And we mentioned earlier interest rate increases. How does that affect it? So I think a lot of it is just using all the resources we have and putting it into our modeling. And Paul may have some to add to that as well.
Yeah, so just a couple of things to dovetail. So, certainly, first of all, in the blocking and tackling underwriting, the financial analysis that we do, the way that we think about interest rates today is certainly different, right? So we're using much higher interest rates, and when you change that assumption, it means your debt service coverage goes up, which either means you need more cash flow or less debt to make your loan work. And so using that one specific metric, that changes how we think about loans. And what that usually means today is for real estate investors, they have to put more equity in to make the same project work because interest rates have increased more quickly than their revenue has. And so that's a real tangible change that's occurred over the last 12 to 24 months and will likely continue in the future, that the way that we think about in the trenches analysis and how those loans are structured has changed. And then the second, to Stephen's point, I talk about business model risk or industry risk somewhat interchangeably. It's being mindful about how that changes and leveraging third-party sources like IBIS World, which is a great industry risk tool to understand how all those different segments are impacted and what that means on a go-forward basis for the next 3 to 5 years. Both of those are critical to how we assess risk and make lending decisions.
Thank you, Paul. So, as we were already talking about interest rates, so we are aware that under the high interest rate scenario currently which we are facing, there has been a flight of capital into the money markets. So people are investing more of their funds in the money markets. So, how is this impacted your institution? Have you seen any changes in in the investment decision of clients?
Well, there's a few things, and hopefully between the two of us, we'll hit all of them. So, the biggest impact is it impacts your earnings, right? Because people are moving, we're having to pay more on deposit accounts, and we can't increase our loan rates enough. So that's why you see all this noise in bank stocks, because depending on how your balance sheet is comprised, that's how much it's going to impact you. The second is it reinforces the things that Stephen and I have been talking about. We're a community bank, we're a relationship-based bank, and so we do have the ability to have deep relationships and still have those non-interest-bearing accounts. The tag on to it, though, isn't it? It's Stephen and I are more observers of this and maybe partners of it. We value those checking accounts far more today than we probably did a year or two ago. And so for the organization and for all banks, we're all figuring out how to go get those non-interest bearing accounts because they're a whole lot more valuable today. In terms of, the question about investment decisions, and candidly, I'm not as close to individual consumers. We tend to be more of a commercial focus. I don't know that I've seen a lot there. Certainly, there's been a trend over the last decade. Consumers are getting a whole lot more intelligent about online deposits and maximizing their returns. And that just means that we need to get smarter as financial institutions to meet their needs.
Thank you for your answer, Paul. So this question is for you both. Since you've been at the center of consumer needs relating to credit, can you discuss any recent trends in consumer credit behaviors that have impacted your credit risk strategies?
Stephen, do you want to go first or you want me to?
So I was going to let Paul go first, and just full disclosure, I'm not really involved on the consumer side. It's a different area of the bank, but I think between the two of us, we can probably answer, but I'll let Paul start.
Yeah, so, and I'll also raise my hand and say, my background in commercial credit is far deeper. And even for our organization, the way that I think about consumer credit is, first of all, for us, we offer those products. They tend to be smaller. They line up with certainly what our consumers need in all of our markets, but from a risk management standpoint, because they're smaller credits, you tend to put a fairly static structure in place, and then you have criteria around minimum credit score and loan structure. So it's a less dynamic type of risk to manage. We've seen a little bit of stress in that segment, really, certainly based on the impact of inflation, which is going to impact the consumer more so than a business client. We've seen a little bit of stress in terms of repayment risk and a little bit more use of home equity lines, but nothing too severe. And we are not, I need to be careful because we're a privately held company. We don't have deep insight into any kind of impact on credit cards, which is likely seeing more volatility than we have any awareness of.
Thank you. Thank you both. Since no session can go without mentioning AI, this is on artificial generative intelligence. It has a profound effects on all industries, and I would like to know from both of you, what are your views on its impact on operations, services, and risks, and how do you see the role of credit risk officers evolve with the adoption of AI and machine learning?
So really, AI is the future, and so I think all companies in some way need to embrace AI, because if you don't embrace it, you're going to be left behind. But I think specifically for banking and for us, it allows us to target products and services to customer needs. The more that we know about our customers, the more we can target, ways that we can help them with products and services. I think specifically on the credit risk side and the underwriting side, it also allows for more automation. We're already seeing the ability to auto spread financial statements and tax returns. And whenever you use those auto spreading services, initially you have to do a lot of adjustments, but with machine learning, each time it's more and more accurate to the point that needs less and less human intervention. And then I think also the ability to auto decision certain types of loans, such as small business loans, based upon characteristics of those companies. But AI is really about gathering as much data as you can and serving the customer through products and services that fit their needs.
Yeah, just a couple of tag-ons. I'll double down on Stephen's comment on AI, and I'll also raise my hand and say not a deep expert, just have a casual knowledge of it. But in the lending and risk management space, the biggest impacts will be more operational, which is replacing low value manual human processes today, which will be good for organizations, good for the economy. Will be interesting to see how it impacts the workforce over time. Those will likely be realized far more quickly. When you enter into the space of decision making, that'll be interesting. We as credit professionals have been faced with even before AI, regression-based models that can generate a score and replace a human decision, those have been out there for a while. So AI will certainly improve on that and will continue to replace a segment of it. The question will be, and this will be interesting, how big of a risk decision are you willing to make based on AI? I'm a dinosaur, and so I'd rather have a Stephen than any AI model. But I won't be here forever. So it'll be interesting to see how it evolves. It's certainly a reality. It's not going anywhere. That said, you're still always going to need judgment as part of your mix. It's just going to be, the percentage of AI relative to people is certainly going to increase over time. I just don't see it completely replacing it.
So I would like to ask a question related to this. So as we see that recently we are moving to more tech-based and more like AI is a part of it. So being a traditional finance professional, how do you emphasize the importance of other programming languages or technical tools used in the financial industry, and how well versed should we be in those kind of tools? Consider it as SQL or any other programming language.
Well, it's a good question, and I'll be curious where Stephen weighs in as well. I might have a little bit of a different take on it. So the first thing, and certainly any background you have in technology that you line up with risk management, I would encourage. I would think first about also making sure that you're familiar with quantitative theory. And not necessarily a deep theory, but regression analytics and some of what goes on there, because those models are used in the risk management space, and the more familiar you are with it, the better. But honestly, I would encourage you more towards a process management and how to use applications with risk management from a user experience perspective. And so both Stephen and I, and Stephen more so than me, have been involved in a project here, but it's more how do we leverage technology to improve our lending process, but it's less about the coding and more about how to use technology. So that's a far more interesting space, I think, that I would encourage you all to explore. And then with that would be any kind of process management, Six Sigma training, because there is a future there that AI is not going to replace. And I see that as being a huge opportunity for all of you in terms of a potential path in credit and risk management.
Yeah, I think Paul covered it well. I don't really have anything to add. I think, as he said, the process management is a big part of it as well.
Thank you so much, Paul. So my next question is for you, Stephen. So now moving on from the economic trends, I would like to understand some of the events that you talked about. So you mentioned that you conduct leadership events for the community, for the clients, and a lot of events actually. And I've also been to one of the events. That's where I met you in the networking event. And First United Bank also conducts a lot of community events as well. So as a finance professional or as a student or who is trying to get into this industry, how should one put themselves ahead? Like, how should I present myself? Could you share anything with that?
So as you said, Raj, we met at a networking event. So as far as First United in particular, I would encourage all of you to follow us on LinkedIn, because we put events that we have in the communities on LinkedIn. And so in the Dallas area, we typically do 2 networking events a year. So I think coming to things like that is certainly a good place to meet bankers, to meet risk professionals. Also, Greg Carter is one of our recruiters in the Dallas area. Actually, he handles a number of markets, but I would also recommend following Greg Carter on LinkedIn. And between those two things, you'll at least know what First United is doing. But even more than that, I think getting involved in any professional organizations or activities that can help you with additional networking, whether it be some type of a club or some type of a business or professional association. I think as young credit professionals, as young bankers, networking is the main thing to learn from others and to have those contacts for your career as well.
Thank you so much, Stephen. And just on the importance of networking, and since we will be putting ourselves out there as maybe interns or analysts in new companies, what do you think on mentorship and how important it is to you? And we would love if you could share any personal experiences with mentorship.
So, yes, but before I do that, you mentioned internships. So definitely look for internships. If you can do a summer internship, that is a great way to get into a company. An internship is more or less a 3-month interview. So it's a great opportunity to put yourself out there and potentially find a permanent job. But as far as mentorship, that's very important. All of our young people, we encourage them to form mentorships, and you can have more than one mentor. You can have 2 or 3 or 4 mentors. And what we look for is, how can that person benefit? How can they learn? And specifically, we have a training program for young credit professionals who want to be lenders or potentially want a career in credit. And one of the things we ask them to do is to work on setting up that mentorship, be it with a loan officer, be it with a credit officer, market president. And we encourage them to have a meeting at least once a month with that mentor and come prepared with questions, ask lots of questions. And I know as a young banker, I had a couple of mentors who helped me in my career. And I think they are partially responsible for helping me get to where I am today because they took the time to coach, they took the time to talk. And I think, if you have that symbiotic relationship, it can help you get to that next step in your career.
Absolutely. Paul, what are your thoughts on this?
Yeah, I share Stephen's perspective across the board. And I'm going to use strong. I'm trying to figure out how strong to land on it. There is no doubt in my mind that the reason why I've had the opportunities that I've had is I've had the chance to work with folks who are willing to commit the time and help me out. And that's been early in my career at BB&T throughout my entire career. But here's the other side of it. 2 things that I would say. The first is when you ask people, be prepared to hear no, because that'll happen, but be persistent. But also realize it's a 2-way street. And so the way that I've always viewed it, and still my expectation today is you should be working harder and you should be bringing value to that relationship. And so really challenge yourself. There are a lot of folks, and Stephen and I, we've talked about this offline. It's one of the things that we look forward to doing kind of in the twilight of our careers. It's very satisfying, but you want to see people who are not just working at 100%. You want to see people that are leaning in and clearly working harder and putting in that extra effort to bring value to that relationship. And so, the last thing that I'll say is those relationships can look and feel different. I had mentorships that were how I created relationships with a lot of the senior credit folks that I learned a lot of how to think about credit. And then I also had a formal mentoring relationship with a member of executive management at BB&T. They both felt very different. They both operated very differently, but I think back on all of them as helping form the person that I am today. So I guess said differently, I'd be creative about it because those relationships can look and feel a little bit different as you move through your career.
Absolutely. I think mentorship and getting feedback from people who are in the industry and have been there for a while as young professionals is extremely important. And now we'll just open the floor for questions that the audience may have. So feel free to unmute yourself or maybe put your question in the chat. And yeah, we can take those up. Come on, let's see who's the brave soul here.
Usually takes one to get the ice.
Just yeah, it
Yeah,
just
and
starts
and
from there.
I'll tell you, Paul and I are really not scary bankers, you know. We actually have friends and we're friendly people, so we're not scary.
Hi, Paul. Uh, Hi, Stephen.
Uh,
I think so. We have someone.
yeah, I have a question. Uh, I wanted to know, what are the biggest challenges you anticipate for credit risk professionals in next 5 to 10 years?
Well, I guess I'll get started and I'll answer it two different ways to a lot of the things that we talked about before. So I'd say for folks in the early half of their credit professional, it's how are they or how are you going to adapt in the changing landscape? So we talked about a lot of the roles that you get started on are being a credit analyst and doing statement spreading or being an underwriter and doing some of those manual tasks. And so it's how do you learn about what's happening in that space, lean in and talk to banks about how they're evolving and figure out your value proposition. That's going to be a real challenge. Now, talent is still needed, but the path that Stephen and I took there's a fairly straightforward path. You usually start in some kind of an entry level position. You work hard your way through it as some form of a credit analyst, and then you move on from there. Your path is going to be more dynamic than that. So that's part of it. And then for folks in the middle to the back half, it's the same thing. How do we adapt to a changing work environment, which is far more, again, dynamic, tied to technology? You know, and Stephen's done a phenomenal job leaning in and adapting and being a great partner with his market. He's out there talking to a lot of clients. There will be some folks that adapt that way and other people who don't, that will need to find a different role within the organization, probably something that's not client facing, does not have a tie with technology.
Yeah, I would say a couple of things to add on to that. Paul mentioned client facing, and you think of the traditional credit role as not client facing, but at least at our bank, it's a collaborative effort. I work very closely with our loan officers. I work very closely with the market presidents. And so I am out, if not on a daily basis, almost on a daily basis, sitting in front of clients and helping get deals across the finish line, talking about terms and structure. But in addition to that, I think just as far as challenges, we will continue to have changing economies. We'll continue to have industry trends that some industries are going to flourish, others will probably not. We'll continue to have volatility in interest rates, changes in banking regulations. So I think all of those things present potential challenges. And then the other thing is, from a bank standpoint, staffing. We compete against brokerage companies, investment banking, other types of financial companies. And just to be honest, I think there's an aging population of credit professionals, and we need young people coming up through the ranks who can take on, more responsibility and who can replace people who are aging out over time. So I think there's lots of challenges ahead, but I think, as was mentioned earlier, just apply yourself, work hard, learn as much as you can, and there's always opportunities out there.
We are sure there's no end to learning.
Yeah, we like to say that we are lifelong learners. You can be in this business for a number of years, and at a certain point you could fool yourself by saying, hey, I know it all. But realistically, we never do, because just as soon as you think you know it all, there will be a company that comes along that's different from anything any of us have seen in the last 20 or 30 years. And so we have to learn about that company. One thing that I think is very interesting about our business is that it's not really cookie cutter. It's our job to learn about every type of business that comes in front of us and every industry that comes in front of us, and understanding, is there seasonality in that business? How do they weather economic cycles, and how have they weathered them in the past? So again, lifelong learners. There's always something new to learn.
Absolutely.
I have a quick question, Stephen. Can you share an example of a challenging client situation that you have faced in your journey, and how did you successfully manage to solve it or tackle that?
So yes, in fact, this was something that Paul and I recently worked on, and of course, we're not going to give client names, but I can give you a profile. We recently looked at a company that is in the solar panel business, and I had never worked on a company in the solar panel business. I don't think Paul had. So it's challenging in that they sell to consumers. So we don't really have accounts receivable. If you're setting up a working capital line of credit, you usually have accounts receivable to lend on. And then as a secondary source of collateral, you usually have inventory. But you typically don't want the line to be too inventory dependent. So you typically limit what the advances are on inventory. Well, this particular company had good historical cash flow, but it was very inventory dependent because we had no receivables. We were lending just on inventory. So as a bank, how do we lend on solar panels? And if we ever became the owner of solar panels, what would we do with them? So I think the way that we overcame that is that Paul and I and one other member of our Texas credit committee visited the company, not all at the same time, actually, but 3 of our 5 committee members went out, toured the company, met with their management team, learned about that business, learned about the risks, learned about the successes, looked at the historical cash flow when they've been very, very successful. So we were able to make a credit decision on a relatively large facility for us that didn't fit the mold. It didn't fit the box. But I think it boils down to going out and spending time with the management team, understanding the business. It would have been very easy for us to say, oh, we've never done that. We don't know anything about it. We're going to pass. But I think part of our culture is learning and seeing if we can mitigate the credit risk based upon the knowledge that we learn. And in this particular situation, I think we made a really good decision to move forward. And we have a company that will hopefully be a very good client for many, many years, but it boils down to taking the time and effort to learn and see how it might fit our risk appetite.
Thank you, Stephen.
Do you have anything to add, Paul?
Well, mine is a little bit of a different twist. So when I first started as a lender, I worked for a bank in West Michigan, and we had just been acquired by a larger bank, and they completely messed up the conversion, and we had all sorts of customers that were getting incorrect bank statements. So I walked into the job and immediately had 25 customers that had some kind of a mistake happen. So they were all frustrated. There was a lot of challenging conversations and a lot of language I won't use again. And so what I learned from that, and it took me a while to learn it, was once you could show people that you could solve a problem, that's typically the best way to diffuse it. And so I still think about that today, where most of the time in our industry, there's been some kind of mistake made. As soon as you can either solve the problem or get somebody who can, that's typically what a customer wants from a financial services company. So it was a very painful lesson for me because I was probably 31 at the time. Did not have the inventory of professional skill set that I have today. So I just listened a lot, told people I'd get back to them quickly. I have a high sense of urgency, and so was able to work through it over a challenging few months. But again, the takeaway is if you could solve somebody's problem, that's a good way to deal with a customer issue or a customer complaint.
what we understand is there is a lot of field work involved and a lot of building client relationships and not just sitting behind some numbers and assessing the risk.
Right.
Do we have any more questions from this audience?
Hi, Paul. I have a quick question. I just want to know how does the First United Bank stay competitive, like in terms of risk management practices, when compared to larger banks that have more resources?
So the question was, how does our risk management approach compare to larger banks with more resources?
Yes.
Okay. It's a great question. I'd say having worked at banks of 3 different sizes, the approaches are actually more similar than you would think. I mean, we're still, even though we're looking at smaller loans, we're still typically following the same process and using a lot of the same tools. What I would say is, again, we're going to value decision makers like Stephen, and I make decisions too, but we're going to value that decision making more so. A larger organization is more likely to deploy some type of a decision model or technology. That would be the biggest distinction. Aside from that, a larger bank, there aren't too many things that they would invest in that banks our size don't have access to.
Hi, Paul. I have a question. This is related to the ESG policies that we were talking about. I mean, the political parties, both the political parties, usually they have like opposite views when it comes to these ESG policy, right? And how, is it gonna impact like if the tide changes in the November, like especially your underwriting policies and all that?
Yeah, I'm not sure, and Stephen may be closer to that than I am, how much that's going to change. And again, because of our size and being privately held, we somewhat have the benefit of being less impacted by that. What I would say is we will likely be, well, we would potentially be more impacted by regulatory changes. But by and large, again, given our size, and I'll knock on some wood on this too, because it can have a pretty big impact. Most of those are going to impact banks that are much, much larger than us. But we'll still keep a close eye on it. That, and also we've got very deep and long-standing relationships with all of the regulatory agencies. And so even if there is a change in administration, I think our examiner in charge has been ours for 25 plus years, Stephen. So she's been through a lot of different administrations on all points in the spectrum, and I doubt it's really impacted how our organization is evaluated.
Yeah, and just to tag on to that, Paul mentioned our size, and I don't think in the introductory comments we really talked about that, but First United Bank is about 16.5 billion in assets. We're in 2 states, Texas and Oklahoma. We have 70 some odd locations, I think around 73, 74. Our roots go back to 1900, Durant Bank and Trust in Durant, Oklahoma, and then we grew as a bank in Oklahoma and then came into Texas about 17, 18 years ago. So again, when we're talking about our size, just wanted to clarify, we're about 16.5 billion in assets.
Thank you.
So,
I just wanted to ask a quick one. Take us back a bit. I wanted to find out if you could give me an insight into the thought processes when work from home became a thing, and how this impacted your risk outlook on CRE loans, whether this risk outlooks came out as you expected, and what are the learnings moving forward?
Yeah, so it may have just been breaking up for me. I think that was, how did work from home impact commercial real estate?
Yes.
Then what we thought versus what actually happened?
Yes, and then what are the learnings that we take forward from that?
Yeah, I mean, it's definitely one of those that I don't think anybody saw that coming in terms of how we thought about commercial real estate before COVID and before work from home really got traction. What I'd say is it's probably not as bad as certainly I thought when all that first came along. Certainly it has impacted office, and there are markets that will never recover where it's fundamentally changed the way that different parts of the country are going to operate. That said, we are seeing a little bit anecdotally of people wanting to come back to work. Work from home for a lot of folks, it sounds great. And I still, will do it sometimes on Fridays. But if I had to work from home every day, I love my 2 rescue dogs and my wife, but I would not enjoy it as much as my partners here. So I think you'll see that slowly and over time come back. That said, office and some of the surrounding areas are still going to be transformed in a way that will long-term be okay, but in the short term, there'll be a lot of pain there.
Yeah, and just to piggyback on that from the human side and giving advice to young people who will be professionals, I think there's 2 issues with work at home. One is if you're part of a company that has a culture, it's hard to be part of the culture if you're working from home. Technically, I'm approved to work from home, but I don't like to work from home because I want to be around people. I want to be part of the culture. I'm fortunate I just have a 15-minute drive to work, but I'd rather drive 15 minutes to get here than to wake up and start working on my laptop at home because I enjoy being around people and I want to be here. But the other thing, just as young people starting your careers, I feel sometimes if you work at home, it's almost out of sight, out of mind, which is not always the best for your career. I think if you have the ability to be around decision makers, if you have the ability to be around your boss, to be around leadership, I hate to say this, but anytime a company has layoffs, I feel like the people who are present and seen every day are less likely to be laid off. And I'm not saying that work from home is a bad thing. I just think that work from home 100% of the time in certain industries is not always the smart thing to do. So again, I would just say be present, be visible, and be part of the culture.
Makes perfect sense. Do we have any other questions?
Yeah, I have one question. Uh, yeah. Could you tell me if there are any recent innovations in credit evaluation or risk management that would be quite promising and we should look out for?
I'm sorry, I didn't catch the.
So the
Okay,
question
so my,
was on innovations. Are there any promising innovations in credit risk which will stay on for a long time and uh, will help the industry?
Yeah, I think back to the earlier discussion of AI and its impact on more operational process. And certainly AI and other things will contribute to better decision making. So, AI does its thing. You've got regression-based analytics that can take a bunch of inputs and help you make better decisions. I think that will continue to be a positive for the industry and for consumers. Not so sure it's a positive for people that want to be employed in the field, but it'll be a positive for the industry.
Yeah, and the only thing I'll add is I'm going to date myself here, but I talked about working in bank operations during summers while I was in college, and there was so much that was manual. Back in the day, people filed checks manually. They weren't processed with automation. So I've seen in my career lots and lots of automation in banking, and I think where we are now is just the tip of the iceberg. I think there will continue to be more and more automation. As Paul said earlier, I don't think it will ever completely replace the human element. It will not replace the human decision making, but it can help us be more efficient and it can help process us. So I think innovation, there's things out there that we haven't even thought of yet that, maybe 5 years from now will be very common.
Yes, there's a saying that AI is not going to replace people, it's going to replace the people who don't use it. So, yeah, I don't think our
Exactly.
jobs are safe. Awesome. Thank you so much, everyone, for joining today's speaker session with First United Bank, and your participation made this event very engaging and insightful. A special thanks to our guests from First United Bank for sharing their expertise, and we found this discussion very informative. Stay connected with us for future events and feel free to share your feedback or any further questions that you may have for Paul and Stephen over email, and maybe we can forward it to them. Thank you so much, guys.
Absolutely. Thank you for having us.